All right, welcome to The Explainer. Today, we're exploring some source material that really steps up the game. Now, if you joined us for our previous breakdown on conservative portfolios, you know we focus heavily on playing it, well, incredibly safe. But today, the data is leading us toward a moderate risk strategy. This blueprint is specifically designed for mid-career professionals. If your life is relatively stable, you've got a steady, recurring income, and your daily expenses are pretty well under control, you are actually in the perfect position to take on just a little bit more calculated risk. And as you'll see, that can significantly boost your wealth.
Okay, let's dive right into this because the sheer difference in these numbers is exactly why we are having this conversation today. Say you're investing $10,000 a month over 7 years. In a purely conservative portfolio, that yields a very respectable 13.2 lakhs. Not bad, right? But by simply tweaking that exact same monthly investment into a slightly more active, moderate risk portfolio, your return jumps to a staggering 18 lakhs over the exact same time frame.
So that leaves us with a gap of 480,000 rupees. We're talking nearly $500,000 rupees. The source material actually calls this the cost of inaction. Basically, by stubbornly playing it entirely safe when you actually have the stability to take on moderate risk, you could literally be leaving nearly 5 lakhs on the table over just 7 years. So let's look at exactly how the source suggests capturing that missing opportunity.
Which brings us to part 1, the strategic recipe, also known as the 4-bucket strategy.
To actually capture that extra growth, we need a better blueprint. And the source compares portfolio construction to following a well-balanced culinary recipe. You can't just throw a bunch of random ingredients into a bowl and hope it tastes good, right? You need precise measurements. So here is the macro-level theory. 65% goes to equity, 20% to debt, and 15% to gold. This specific ratio right here is the magic middle ground. That heavy 65% weighting in equities gives you the aggressive growth potential you absolutely need to multiply your wealth, while that combined 35% in debt and gold, that acts as your essential safety cushion. It's really the perfect blend of offense and defense.
And this brilliantly illustrates how we translate that macro theory into real-world action. And it's surprisingly simple. Notice we aren't buying individual stocks here. The strategy builds this entire portfolio using just 8 carefully selected exchange-traded funds, or ETFs. We park 40% into stable large caps using SPI Nifty 50 and Junior Bs, which captures India's top 100 companies. Then we rub up a growth engine with 15% in the midcap 150 ETF. We also step outside of India with a 10% allocation in the Mod 100, which tracks the nasdaq. And finally, that 35% safety cushion is split up between reliable debt funds like Bharat Bond and SBI Gilt, right alongside Gold Bs and SBI Gold.
I absolutely love the food analogy the source uses for that 10% international allocation. They say that international funds are like chaat masala. Think about it. When you sprinkle just a little bit of this spicy seasoning on your dish, it elevates the flavor completely. In financial terms, that 10% exposure to the 100 gives you direct access to explosive global tech giants. We're talking Apple, Meta, Nvidia, and that provides a spicy boost to your returns and a great hedge against the depreciating rupee. But if you dump the entire bottle of chaat masala into your food, yeah, it becomes totally inedible. Over-allocating globally will absolutely ruin your portfolio's balance because those markets can be wildly volatile. So 10% is that perfect pinch.
Keeping with our food metaphor here, if the international and mid-cap funds are your spicy flavors, then the 35% you've allocated to debt and gold acts as your portfolio's digestion engine. Look, the markets are totally unpredictable. When a sudden global crisis hits and the stock market gives you a severe stomachache, this specific combination of debt and gold is the critical nutrition that steps in, settles things down, prevents your portfolio from completely crashing, and ultimately keeps your wealth safe.
All right, moving on to part 2, stress testing past performance.
So, theories and metaphors are great, but the source actually stress tests this exact 8-fund recipe against real historical market conditions to prove its resilience. And the results are wild. When tracking this moderate portfolio against the standard Nifty 50 benchmark and a traditional fixed deposit from 2019 to 2024, the strategy consistently crushes the 6 to 7% returns of a standard FD. But what's even more impressive, it heavily rivals and honestly often beats the Nifty 50. You are getting superior or equal performance, but with significantly engineered safety nets built right in.
Let's actually zoom in on a moment of extreme market stress, the 2020 post-COVID recovery. Remember that? After the initial crash, the broader Nifty index bounced back with a very solid 15% return. However, our moderate portfolio? It surged by a massive 24%. Why the huge difference?
Well, it's because the inclusion of those agile mid-cap and high-growth international ETFs acted like absolute rocket fuel, allowing the portfolio to capture that recovery so much faster and way more aggressively than just relying on large-cap stocks alone.
But hey, the real test of any strategy is how it behaves when everything goes completely wrong, right? Let's look at 2022. Triggered by global panic during the Russia-Ukraine war, markets completely freaked out. The nasdaq, our spicy chart masala, crashed by a painful 20%. The nifty dropped by 2%. But this blended moderate portfolio, it only dipped by a mere 2.8%. That is the digestion engine of golden debt doing exactly what it was designed to do, protecting your hard-earned wealth from a global freefall.
Which brings us nicely to part 3, the magic of SIP.
So, we know the recipe holds up in both good times and bad. But what actually happens when you automate this whole thing using a systematic investment plan, or a SIP? Well, over the historical period analyzed in the source data, this specific 8-fund blend generated an average compound annual growth rate of 17.2%. Let that sink in for a second. We are talking about long-term annualized growth that sits very comfortably above inflation and standard market returns.
Let's put that into perspective and see how it builds exponentially over time. If you invest just 10,000 rupees every single month into this specific ETF allocation, after 7 years, your total invested capital of roughly 8.4 lakh rupees practically doubles to a total value of 16.3 lakh rupees. That is a 94% return on investment. But the true magic of compounding happens when you stretch that timeline out just a bit further. Stick to this recipe for 10 years, and you aren't just doubling your money. Your pure gains alone hit 19 lakh rupees. That represents a staggering 166% absolute ROI.
Oh, and there is a hidden advantage here that is absolutely vital to point out. Unlike actively managed, heavy mutual funds that charge you high fees just to manage your money, these ETFs have basically negligible expense ratios. We are talking rock-bottom fees ranging from just 0.07% to 0.20%. Why does this matter? It means that the vast majority of that 17.2% average growth stays exactly where it belongs, directly in your pocket, compounding year after year, rather than being slowly eaten away by management fees.
Finally, let's wrap things up with part 4, 3 rules for success.
So we have the blueprint, we have the historical proof, and we have the automation strategy. But listen to me. Having the blueprint isn't nearly enough if you lack the discipline to actually follow the instructions. The source explicitly warns of 3 fatal mistakes you must avoid. First, stick strictly to these 8 ETFs. The second you start getting overly creative and expand to 10, 16, or 20 funds, you dilute your potential returns, you mess up those low expense ratios, and you break the tracking ability of the portfolio. Don't do it. Second, cap your global exposure at 10%. Remember the chaat masala rule. Too much international exposure invites devastating volatility. And third, do not panic sell.
So the crucial point I really want to drill down on is this third rule, particularly regarding your mid-cap allocation. Look, mid-cap stocks are your growth engine, right? But when the overall market takes a dip, mid-caps don't just dip, they correct strongly. They will look incredibly ugly on your portfolio screen for a little while. Just expect it. It's part of the process. But never, ever sell them in a panic. Having the discipline to hold steady during corrections is quite literally what separates successful investors from everyone else.
As we wrap up this explainer, I really want to leave you with a bit of a challenge. Take a hard look at your current investments today. Are you sitting on a purely conservative portfolio that's actually holding back your true potential? Are you missing your growth engine, or maybe that strategic pinch of international chaat masala? If you've got the stability to take on just a bit of moderate risk, this 8 ETF blueprint offers a proven, highly efficient path forward. So, what's your next move? Until next time, I'll leave you with the excellent mantra straight from our source material: keep earning, keep learning, and keep sharing.